The end of the financial year is fast approaching, so there's no time to waste in making sure you've got your plans in place and doing all you can to maximise your position this financial year. A lot of our clients have got plans in place, worked with their advisor, and things are ticking along, so they may not have anything to do, which is great. Just keep working the plan. However, if you're not sure, I suggest you ask yourself 3 questions to start off with. The first one is, am I on track to make my planned super contributions for this financial year? Second question is, have I taken out the minimum I need from my pension account for this financial year? And the third one is, have I done what I need to do to take advantage of opportunities to manage my own personal tax? So if you answered yes or potentially not applicable to all of those questions, then fantastic, well done, you're on track. You can switch off this video now, read the rest of the newsletter and go and have a fun day. If you answered no to any of those questions, then can I implore you to take 2 more minutes and I'll give you a couple of tips on some things you might want to think about. So starting out with thinking about super contributions. So the first one is in regards to concessional contributions, which are those contributions which you may be able to claim a tax deduction for. So you've got a cap of up to $27,500 for this financial year, and that includes any contributions your employer has made. So if you have some spare capacity or a little bit of surplus savings, then it makes sense to potentially top up your contributions for this financial year, bring forward some of those tax deductions. Another benefit when it comes to concessional contributions is a rule called the carry forward or catch-up concessional contributions. That allows you to go back up to a maximum of 5 years and potentially use contributions you didn't use in those previous years. Now, this is only applicable to people who have a superannuation account balance of under $500,000. So if that's the case, it might be worth having a look at that as well. It's particularly beneficial if you've potentially had some capital gains throughout the year that you might want to reduce by having some more tax deductions, or if your balance is creeping up towards that $500,000, this could be your last opportunity to get these contributions in. And keep in mind they expire after 5 years. So, each year you don't take advantage of it, you're missing out a little bit there. You can also look at non-concessional super contributions. So non-concessional contributions are after-tax money. So if you've got some surplus money, if you've sold some assets and you've got some money in the bank, then you can look at bringing those contributions into play as well. You've got up to $110,000 a year you can make, or you can bring forward 3 years worth of contributions into 1 year. Now, the non-concessional contribution cap and the concessional contribution caps are both increasing next year. So it's worthwhile having a chat to your advisor to think about the timing as you move closer to the end of financial year on some of those contributions. So the second part was about have I taken out what I need to in regards to pension payments. So this is a bit of a tricky one this year because there is a minimum that you always have to take out if you're in pension phase. Last year and for a few years prior, there was a discount, a halving of the minimum amounts that you had to take out. So as an example, for somebody aged 65 to 70, you had to take out last year 2.5% of your pension balance. This year you have to take out 5%. So if you're in a retail fund like a premium or something similar, then the fund will be helping to make sure that you're meeting your minimums. However, it's particularly important for self-managed super funds to check that you've made your minimum repayments. We've seen a couple of clients where they'd set up their regular monthly payments coming out based on last year's minimums. So they've got a fair bit of money they need to pull out in the next couple of months to make sure they meet the minimums. So it's very important to check that. Check with your advisor, check with your retail fund. That should be under control, but best to check. For a self-managed super fund, make sure that you're doing what you need to do because you've got only a couple of months. And the final one is, have I done what I need to do to take advantage of, opportunities to manage your own personal tax as you move towards the end of the financial year? So a few things to think about here are things like if you have sold assets and triggered a capital gain throughout the year, do you have some assets that are underperforming and might be able to trigger a capital loss to offset some of those gains? So if you're looking at those types of opportunities, that can help. You can look at otherwise deductible expenses. So can you bring forward expenses that you can claim a tax deduction for and pay them before the end of the financial year to offset your income for this financial year? There are also, it's important this year to think about your planning over the next 2 financial years, because next year the much publicised stage 4 tax cuts come into effect, which means that most people's rate of tax will be reducing for the next financial year. So for some people, you're not going to pay as much tax next year. So if you can bring forward some deductions this year, that's a really good opportunity for some planning opportunities as well. So those 3 are the key areas. There are many more things you can do in each of those spaces, particularly with the super contributions and managing your tax affairs. But hopefully that's given you some information which might be worthwhile considering. If you want to discuss it further, please get in touch ASAP with your advisor, because you've only got a few weeks to get things in place.